All right. Hey, how you guys doing today? My name is Steven and Gesis, CEO of Smartland. And today on Smartland's Get to Know podcast, we have Aleksey Chernobelskiy. If I didn't get that right, he's going to correct me if he elects. But we're going to kind of keep this real light today and just highlight some of the things that Aleksey sees in the marketplace that are really critical to, I think, what our limited partners have questions on, or limited partners in general that participate in commercial real estate. I think that there's a lot of questions and a lot of interesting uh, just marketplace feedback that gentlemen like Aleksey, who works directly with LPs and general partners, not only on their due diligence, and I'll let Aleksey kind of introduce a little bit more about what he does, but specifically Centrio Capital Partners that Aleksey runs really works on vetting and assisting LPs, but also vetting maybe in doing some due diligence on GPs, going through some of their details, and also assisting LPs with tough situations that they may be facing. And equally assisting LPs maybe if they just have a series of questions and they're seeking clarity. So without further ado, Aleksey, welcome. Thank you so much. And if
Thank
you
you so much for having me.
give us a little bit of background about yourself, and we'll begin with that today.
Yeah, sounds good. Background, I did all types of buy-side investing, eventually got to a REIT, real estate investment trust, where I led a 20-person investment team. Um, in total, was responsible for $10 billion that we had outstanding across the US. I think at the time it was like 2,900 properties. Um, and that was really fun. Eventually, I went off on my own. And so, as you mentioned, right now I run my own firm. The firm advises LPs directly, and that's really sort of twofold. So any LP that has a new transaction and they want me to give them feedback, they can hire me to do that. And any LP that has perhaps a deal outstanding that isn't going according to plan, or they have questions on, I can give them feedback on it. That is again independent. And third, I also write to 5,000 LPs at lplessons.co, which is CO at the end.
So yes, LP lessons. So actually, that's I think where I began this journey with my introduction to you is actually I am a Substack subscriber. So thanks for all that content that you put out. Thank you so much. It's very
Yeah,
helpful,
for sure.
enlightening, and it's really interesting to read because these are some of the things that maybe the marketplace was missing, and education is key. One of the things that we've always been a big and very persistent on here at Smartland is education and education for our LPs and be able to really kind of provide them a guiding light or assistance and maybe some of the questions that they may have because it is a really it is a diverse landscape. And right before we began the podcast, I kind of gave you a little bit of background on us. We've been in this space for over a decade, and one of the things that we've seen is the evolution of how you can communicate with LPs and how you can how you can market to LPs and kind of the information that LPs are getting. And I think that there was
Yep.
some blurriness in the lines as the market got heated
Sure.
in this last market cycle. And so we're seeing some of that dislocation now, and you play such a critical role because there is only such a limited amount of outlets for LPs that need kind of this third party, non-biased, balanced approach to maybe if they're in a positive situation or in a negative situation. And so diving into that,
Yep.
you mentioned, you were, and I think you were with Store Capital, right? You said you ran a $10 billion
Yep.
real estate portfolio. That's
That's
incredible.
right.
That's an incredible, I think, and dynamic thing to have on a resume simply because it gives you so much insight from such a variety of just such a variety and diverse commercial real estate views. So that's really incredible. Can I ask you? You have a really diverse background in major in finance, mathematics, economics, accounting. Um, you know, how does this influence maybe your approach to how you advise your LPs?
My background.
Yeah.
Um, yeah, I think I tend to sort of have like a mathematical way of thinking about things. I don't want to say algorithmic because that sounds too robotic. But I also, what's interesting is at Store, which is where, I led an investment team. We looked at, in some cases, like dozens of deals every single week. It was very busy. I mean, we acquired typically 1 to 2 billion a year. Um,
That is very
and
big.
and in most scenarios, one of the biggest things I think that taught me is sort of just this breadth of like looking at a ton of deals and understanding how to view risk reward, right? Because at the end of the day, we were public, and hypothetically we could buy most of the things we saw, and in some cases we could even restructure some things to make it make sense in a sense, right? But then there's a question of like, can you really price for risk or not? Because at the end of the day, risk is, it really tends to be binary, right? Like you can look at sensitivity tables, and if this happens, but at the end of the day, like you either get a return or perhaps you don't get nothing back, right? Meaning at the end of the day, the outcome is the outcome, right? So that was like a really interesting lesson that I took away, which is it actually tends to be very qualitative in a weird way, right? So I think my undergraduate studies were very like quantitative in nature, and I was sort of obsessed with like, if you can't prove it, it doesn't work. um, and then funny enough, kind of like as I graduated to a senior level like managerial role within a REIT, you sort of realize that quite a bit of the decision has to be quite qualitative as well.
So let's dive into the qualitative, like qualitative, right? So one of the things that, and I'm not going to spend a lot of time with you on this today,
Sure, sure, yeah.
but one of the really unique things that I maybe opened Pandora's box with this. So one of the
I'm
things
ready for it.
in today's marketplaces, right? This market dislocation. So we went from this like big boom, right? Low interest rates, compressed cap rates, high values, and whether it was, it doesn't matter whether what kind of commercial real estate it was, whether it was multifamily or even storage or warehousing, right? Prices went up, rents were going up consistently, and now we're kind of in this plateau bubble. We do have a fall off on multifamily starts, that's known. So we are going to see a little bit of a probably a pushback up in multifamily, but one of the things that this market cycle I think is really showing Wall Street that at least is resonating as some feedback that we're getting from maybe not necessarily just direct limited partners, but if we use direct limited partners in a more maybe direct sense of like family offices or endowments or institutionals or even just throughout Wall Street, maybe a little bit larger players, REITs, is that what has become important to them is boots on the ground and hands on. That you can't really, you meant qualitative, like, are we treating it as a commodity in the sense of we could buy and see what the outcome is, and then we are using, not only growth markets, but we're looking at obviously whatever this asset class category is. But would you say that, maybe some of the challenges arise from not being directly hands on when you're a REIT, and so maybe the quantitative goes out the window, and you're looking at qualitative more.
Yeah, the qualitative is qualitative. In other words, it's really hard to quantify some of these things. I'll just give you a few examples. Like, and I deal with this every day, quite literally, because I sort of advise LPs on deals, right? So you pick up a deck, um, and let's say there's a mistake on the first page, right? Grammar, right? So like, does that mean you pass on the deal just because there's a grammar? So many, to maybe to your surprise, many LPs will say, yeah, like if they can't like spell a word on a deck, like how can I trust them with my 500,000? Um, Funny enough, actually, I wouldn't fully agree with that because I actually led a team of 20 analysts, and it happened all the time. Like, things happen and people are people, and sometimes there's a mistake. And sometimes the mistake would pass by me, right? Like I would look at it and I wouldn't notice it. The analyst wouldn't notice it. We would go to investment committee and there was a mistake, right? And so does that mean the investment itself is bad? No, it just means we made a mistake and we probably need to be more careful, right? Now, the question is what happens if there's a second mistake and the third mistake? And what happens if like, maybe the track record isn't so honest, or maybe not so transparent. Um, what if other aspects of the investment aren't so transparent, right? And you start getting into the ethical component. of the investment, right? And in my opinion, at least, that deals with a lot of alignment issues between the GP and the LP, right? At the end of the day, you have to trust them. And I always tell LPs trust. I mean, you probably saw this article since you're subscribed. I think that the trust but verify idea is a very dangerous idea as far as LP investments go. Like it has to be verify, and then you slowly begin to trust. Because in the beginning, it's a stranger, and like you just can't sort of assume trust before you get to know someone and get to know how honest they are based on some basic tests and analysis.
I think you have a very valid point with that because one of the things that I think we've seen over time also is this trust buildup, right? So even within our ecosystem here at Smartland, we see that we've been around for over a decade, and some of our LPs have been with us for over a decade, and some of our LPs that have been with us over a decade may not even be some of our largest investors still, right? So they may
Yep.
still be going through this trajectory of trust and buildup.
Yeah.
So I think that that is a very valid point. What were the key lessons that you think that maybe your experience at store led into kind of what you're applying to here in your current role? Like, well, how do you think that that really impacted your transition to Centrio and your catalyst here, right? Like, what is this platform that you were really able to take away from store and say, or through your experiences that didn't come out right, through your experiences with such a large REIT, and now translate them into your current role?
I think the biggest thing is probably just looking at a ton of deals, right? Like, if you think about my random day, like I had four teams that reported to me, um, uh, focusing on different industries, and in each one of them typically had like somewhere between 2 to 4 deals that they were underwriting in any given week. Um, and so the conversations I would have day to day is like, is this deal interesting or do we need to pass? Is this deal interesting or do we need to pass? And if you do that across a ton of deals every single week for years, what you start developing is the sense of like, oh, it's okay to pass, right? Like, and I think the opposite is true with LPs sometimes, that like they forget in a weird way that like, the treasury market is still there. Another syndication is around the corner, whether it would be from this GP or another one. And there's a bunch of other investment opportunities, right? And I think sometimes the cash is burning a hole in people's pocket that they just sort of make blind investments. And I, to the best of my ability, try to remind them that, and to be fair, to LP's credit, this is actually very hard to do as an LP unless you sort of get an inflow of deals that you can sort of compare to.
Also, a
Because at
very
the end of the
valid point.
day, sorry, say again.
That's a valid point that actually you just made. Is this, LPs don't have an inflow of deals necessarily, as you just
Exactly.
were about to say. So
Yeah.
go ahead. Yeah.
Yeah. And so what naturally happens is, they get a deal and they're like, oh, like I finally have a deal. And like I have 500 grand in my checking and it's only earning 4.5%. So like, maybe I should invest, right? And you're almost like finding reasons to invest rather than, and there's nothing wrong with that. You should do your analysis however you want, but the point is you shouldn't sort of start with the end in mind. Right?
Yeah. I
and
see.
and
Yeah.
and and the only way you sort of develop that is looking at a lot of deals, and that's why I tell people, so some people come to me and they're like, hey, I have like 15 grand, 20 grand to invest, what should I invest in? And I just tell them you probably shouldn't. Like, and in other words, the amount of time it will take you to look at a bunch of deals,
I read that
vet
article.
them,
I,
yeah,
I,
and
I
vet
couldn't
them
agree more
like,
with I couldn't agree more with that. It should be something more.
if yeah, like it takes a lot of time to vet them, which takes, you can invest that time into something else, into your career, into your kids, wife, whatever it is, right? And
I think
like,
actually that spurred me to sign up to your Substack was that article that I
oh,
began.
really? Okay.
Yeah,
Yeah. Yeah,
because
yeah.
this is such a valid point, right? Like we've fought with this. It's something that's internal here as well because we've had plenty of deals that we've launched even as low as $5,000 for an LP to begin to
Hmm.
start, right?
Yeah.
And there are some inherent challenges. I think that once I read that article, that not so much as us as a platform to intake a $5,000 investment, but I
Yeah.
think that what you're saying from to the LP is much more critical, is that your time spent on vetting to get to this $5,000 investment. If you're prepared to spend
Yeah.
5,000, you should make a 50 or 100 or $150,000 investment, because if you're this confident to place it with this jockey,
Right.
for a better term, right?
Right.
Then, then why wouldn't you've done this. And this is, I think, such a hypercritical moment to, I think, even dive deeper, because this component of the time and rationale to do due diligence on a limited partner, level, to participate with a general partner in any type of, whether it's a single asset deal, whether it's a fund, right? Like, so we have a fund, and we rarely have single asset deals anymore. But if you've done this due diligence, I really, if whoever is listening to this today, if you haven't read this, I'm going to try to get you guys a link to this article, because I think it's so important, because you're spending so much of your personal time to do
Yep.
so much work, and then make such a small step, but yet have, a high expectation. You have to balance that, right? And so I love that we kind of walked right into that.
Right. Yeah, and I think two other things to mention that I think go unnoticed sometimes is first, if someone is investing 5 grand, it could be one of two reasons. Generally, I'm generalizing a little bit, but I think this is true for like 70% of cases. Either they're investing 5 grand because they don't have a lot to invest, and 5 grand is actually quite a bit to them. In that case, I would argue that they're probably not ready to take on this level of like liquidity, risk, etc., etc. Or 5 grand is actually not so much to them, and they're basically making like a venture capital type bet. Like they're just like, like hopefully this works out, but I'm not gonna like spend 10 hours diligencing this thing. It's only 5 grand. But then I would say, okay, so like that also doesn't make sense, right? Because you're basically saying like, let me invest 5 grand and hopefully I'll make 2x, but like your downside isn't protected. The whole point of real estate investments is like, yeah, you can make 2x, let's say, but you're not going to make 10x. Usually that's just not like normal for real estate. So if you're going to sort of YOLO, you only live once, like on some sort of deal, let it be a deal that has like tremendous upside. Like I'm not investment advice, but just as an example, like go invest it in crypto, right?
Sure,
Like
sure. Let it ride.
there the mentality is you're basically gambling, right? You have no idea what you're investing in many
You're just
cases.
standing at the roulette table.
Yeah, yeah, but you're like, like maybe I'll make 10x and 5 grand is not so much to me. And if I make 50 grand, like that'd be amazing. In a month, the guy wakes up, the 5 grand is gone, but they're not upset because that was the expectation. But with real estate, it's the opposite. People wake up and they're like, whoa, what happened to my 5 grand? I thought this was safe. It's real estate, right? And that's like the it's a weird dichotomy that I mean I see this all the time.
Fascinating. So, I think that some of that was spurred through maybe when crowdfunding was introduced for real estate, right? So crowdfunding was introduced into real estate. If I have it correct, I think that was like around 2013 where the initial kind of changes began. And so this world became so accessible. And then more SEC rules came about the ability and how you could advertise and between Reg A and C and D, right? So and then came COVID and came all of what I call, right, like the YouTube general partner sensations, right?
Right.
That really kind of again drove people further, like limited partners not only gave them more access, right? Like an immense amount of access, because now everybody wants to be a passive investor, and this guy's standing there on YouTube or whatever on some sort of social media. He's got to be somebody that is somewhat, and he's throwing these big houses, or big apartments behind. And so we saw a lot of that. And so actually trending out of that market dislocation, we find ourselves in a really unique space here, just at Smartland alone. And that's kind of where we began our conversation today, is that naturally the market kind of what I call, right, like it's just natural Darwinism, right? It just calls the herd naturally, right? So like this market dislocation has caused a shift where we've not only been able to broaden our next layer of the type of asset that we want to buy, and access to that, but also less general partners in the mix. Some guys, not because they're all gone, or not because they're gone. Some guys are in a stabilization mode. Some are just repairing what they have. Some just can't buy anything. Some are in a tough spot financially due to this market dislocation with interest rates. And they've been cutting the rate, but the 10-year treasury is just a force to be reckoned with, right? And a lot of these adjustables are tied to that.
Yeah.
And so the pressure continues to mount, I think, for general partners across the board that have any type of adjustable rates, adjustable rate positions that are coming due, where we've seen rents soften if they haven't done massive value adds or whatever else. We're still kind of, I think, in this hope and delay or pray and delay mode with some regional banks, with some general partners. So we're going to see how this shakes out. But I think that when you're talking about the $5,000 limited partner that was participating in some of these deals, I think that's a real big challenge. And that gets back to really thinking about it, right? Like, you spent the time setting these expectations, doing the due diligence, vetting, but really, did you do a great job vetting it? Or were you just part of, kind of like this market heat,
Hype.
right? Hype. Yeah, hype,
Yeah.
exactly. And
Yeah.
and yeah, and accessibility, and it is sexy, right? Like, multifamily is sexy, commercial real estate is sexy. Like, everybody knows, like, the global space population is not reluctant to know that real estate is a massive wealth builder, and access to that wealth builder needs to be controlled, right? Like, um, it's not that it went out of control, but what are the key steps in doing the appropriate due diligence? I loved how you mentioned, you had all these decks to look at, and declining a deal is just as important as accepting a deal. And one of the things that we discuss here internally at Smartland is just exactly that. Our deal pipeline is like that big right now. It's huge. Um, and for us, it's having a systematic approach on due diligence. We have an acquisitions team. We have, the same thing, just like how you did at the REIT. Similar, we have an intake team, and then it goes through our variety of steps, whether it's a qualified or unqualified deal, and whether we're going to do more due diligence, or we're going to set it aside and we're going to track it. And so there are systematic ways to approach it, but that gets back to, again, exactly as you said, whether you have an unlimited or a limited amount of money, it really doesn't matter.
Yep.
Saying no is many times much more powerful than saying yes. And so, I think that what our listeners really would want to know, maybe what are the most common challenges that you're seeing that limited partners are facing, whether they're evaluating deals or overcoming some obstacles, maybe that they're in right now. Maybe you could share some insight on that.
Yeah. Look, I think the most common thing, on anything that was previously invested, the most common thing is capital calls right now. And I still think that, I don't, this isn't the scientific number, but of the deals that have their LP equity wiped out, in other words, if you were to sell the property today, the LPs won't get anything back. I think roughly 50% of the LPs that are invested in these deals aren't even aware of that. In other words, there's a slice of LPs that either got a capital call with some information, or the GPs were like, transparent about, hey, we have issues, like your equity isn't worth much anymore. You need to reinvest in order for us to save the deal. Um, but I think the vast majority of people don't even know. Like, they're just sort of, plugging and chugging with their job or business or whatever. And they sort of assume that that investment is still intact, but it's not. So I always encourage LPs to proactively reach out. If you bought something or invested in something in, let's say, 2020 through 2022, I think it's very wise for you to check in on your investment, at least briefly, if you haven't heard anything in particular. And by the way, even if you have heard stuff, like, make sure that it's a material update is what I would call it, as opposed to, like, a picture of a dog park every month. Not that,
So
I
let's
have
talk
any issues
material
with dog
update.
parks.
So, like, a
Yeah.
balance sheet, P&L included. So, we do this type of reporting. So I love this. I mean, this is exactly what our not only LPs want to know, but I think you've hit it right on it. I think LPs don't even know in many
Yeah.
cases. Um, we encourage folks to visit us and do a property tour. One of those things I
Yeah,
think.
so this, this sounds funny probably to you, but like, I mean, it's nice to visit a property, right? It's nice to visit a property. It's nice to have a picture of a dog park. It's nice to have a lot of stuff. But my point is, a lot of updates are actually sort of like kind of irrelevant. At the end of the day, obviously you want to, know that like the tenants are doing well, the property is well kept, et cetera, et cetera. But I can tell you, I don't know, probably 100 examples by now of cases where the property looks super nice, the property manager is smiling, the tenants are walking in, and yet the equity is gone, right? So meaning, as an LP, you have to understand that there's like a big difference between sometimes what you see and what's behind the scenes, because at the end of the day, the behind the scenes is just a capital stack, and like it either works or it doesn't currently, and there are ways to fix it, right? If it doesn't, but like the numbers are sort of the numbers, and what I find is that a lot of reporting packages tend to I don't think it's I really don't think it's on purpose, but they just inadvertently sort of like tend to hide the most important things over time. Like you look at and by the way, for this reason, I tell LPs like personally, I would rather get one good reporting package a year than get them monthly and have them be meaningless. Like I don't want to be bothered every month to look at a picture.
Yep, I can agree with you on monthly
You know what I'm
reports.
saying?
Excessive, yeah. So one of the things that we fall back on is we do quarterly. So we will do a quarterly report. Is it the best pulse of the nation? And the question I think really is not only I think do LPs need to have a report throughout, and you're right. Like, what is the we struggle with this too, right? Everybody does. I don't think anybody has a the best answer, but I think that what we work on is trying to be the best provider and most transparent provider. And I think if we can master that that that's a long that alone, I think says a lot about an operator, right? But you're right. Like but sometimes, you just the reason why I'm so hesitant to say this because one of the things that you said is that, hey, like if you invested in between 2020 and 2022, you might want to get a pulse on things, right? Like we just said that in this conversation, and so that's a valid point. And they might be getting these pulse points, and are they of value? Questionable. That's kind of what we're alluding to, and now you're saying, hey, or we're saying in this space is that what they may not assume is that they may have already been wiped out. Okay, so if we dive into that, and LP being have already been wiped out, and earlier on in this conversation, we're actually targeting exactly that type of asset, right? Either from direct from lender, direct from broker, direct from whoever it is, right? Where in this case, really, what is 25 to 30% of an asset's value? It's the limited partner's position, right? In most of these environments today.
Yep.
And so you're right. So that goes back to, pray and pretend or whatever these banks are doing, or hold and pray or whatever they call them, hope and delay. There are all these like, cute little names that they're giving them. And yeah, and so it's happening. Some of these LPs are going to be caught kind of off guard. Um, there isn't a platform that I think really what I was hoping for when 2013 and the SEC rules came out with the changes and how you can how you can communicate with potential limited partners, or how you can raise capital. What I was really hoping is that a real ecosystem was going to be built, right? One where there could be a lot more sharing, because that was the intent. Because this whole commercial marketplace is highly inefficient, it's highly fragmented. Outside of mom and pop, there's the guys like Smartland, right? And then there's the REITs of the world. So we're like this middle layer available to a larger platform where we're buying deals that are not necessarily, we play outside of a sandbox, outside of Blackstone's or Brookfield sandbox, right? We're buying slightly smaller than institutional level deal and greater than mom and pop. But the resounding answer still today in 2024 is that there isn't a real like singular platform, right? Where LPs can not only get feedback, have access to deal decks, have access to, like, it doesn't exist. And like in 2013, 14, when that crowdfunding shift began to occur, one of the things that we really believed in is that there could be this the Facebook of for limited partners, right? And it still doesn't really exist. Part of that I think has to do with what you just said earlier was with GP reporting, GP due diligence, GP this. So some of it starts at the top level as an issue actually with getting a good general partner, right? As getting a good operator, getting into a good deal. And so some of these largest challenges, I think, begin at the top and then trickle down for LPs to have access to. There are some platforms out there, and they have kind of manifested into something else over time. Like before, you can go on to a crowdfunding platform and you'd find Smartland and Store Capital or Centrio Capital and these guys and these guys and this guy. And slowly over time, the crowdfunding platforms became their own general partners, and they're just raising their own deals. Essentially today, most of them. I mean, maybe there's like one or two, and I don't know. I don't really follow that so much. But this transparency wheel is so critical. I think that my question to you, I think really now is how do you assess this current risk of landscape, and what strategies do you recommend for LPs to begin to mitigate some of these risks, right? Like they're in it. How do they know it? Like is there a market that is there a signal? We've worked so hard on working through this last market cycle to make sure that we're coming out stronger than ever in face of the market trends of higher interest rates, in face of plateauing rents, in face of expanding. There's things that general partners could do to drive and to maybe it's an issue with general partners. Maybe the issue is there's just a guy with a camera and there was no team behind him like we have at Smartland or you had at Centrio, right? Or at Store, right? So I'll leave that to you. What do you think? How LPs can mitigate risk?
Um, a lot of answers to this. I think I'll keep it high level. The biggest thing, and I think this, perhaps this is just a follow up to our earlier discussion on the 5 grand, right? Real estate investing is not like gambling, right? Because if you want to gamble, I go to the casino, right? There, at least you know they're gambling, and you will place a bet accordingly, right? With real estate, you need to do due diligence in order to what? Protect your downside, right? That should be a very important part of real estate investing. And so, first of all, if you don't understand that, and you'd be surprised like how many LPs I speak to that call me after losing money and they say, I just really didn't understand that like I could lose money. I thought the worst case is like they sell the property, they pay off the mortgage, and I get my money, right? Like, I mean, it's not so crazy sounding for someone who is like unsophisticated, right? Like, I don't know, like there's a property and there's some debt, you pay off the debt, and I get my money back. Okay, so I didn't get an 8% pref. It's okay, right? But the reality is the education is missing, and a good rule of thumb, I think, is if every investment has risk, even if you can't find it, right? First of all, you have to know that and feel it. And second of all, I would also add to that and say if you can't find 2 to 3 catalysts in an investment that will make you lose all of your money, you really shouldn't be investing. Like that means you did not do your diligence. Those things should not be that difficult to find. And like if you didn't find them and you don't understand them, chances are it's too early to invest.
That's really good feedback. That's really good. Really, honestly, because that really kind of sums up the fact that it is about a deep dive, but also believing into the investment and also having the risk capacity, right?
Yeah.
So having this risk capacity, right? And a lot of folks they don't want to really come visit the property because they are busy. They are busy. You know, so with that being said, this high level of due diligence is so critical. All right, so we covered kind of the LP stuff. What about your work with GPs? Like, what are the common areas that you find that kind of can require improvement, or like capital calls or investment decks? Like, what are the things that you're seeing, and you're like, man, like that sucks. Like
Yeah.
whatever that guy did just now, it totally sucked. Like they could have done it.
Yeah, I mean, I see a lot of it. It's like, I guess I don't really know how else to put it other than I feel like, I mean, it's like any business. You know what I mean, Steven? It's like, when you're running a business, you don't always get great feedback. You know what I mean? And I think with LPs, it's actually even more true because what happens is you send a deck and the LP will be like, what the hell is this? Like, I don't even understand. I just sent like 40 decks to an LP like last week. He's like looking to invest 1 million to 2 million. I sent him a bunch of decks. And his first response was like, man, like I've never reviewed this many decks at the same time. And that was like really useful. Like, because you're just like, wow, there's like so many things to choose from. Like, oh, this is crazy. Like, why would I agree to this when I have this? And then why would I agree to
Sure.
this when I have this? But
Like
but
it's
that was
back
my
to that
earlier
social
point.
plan.
Exactly. So like I think people need to remember that first of all, there's options, right? From a GP's perspective, to your question, what that also means is like you really need to put your best foot forward. And I often see that like I just don't obviously this isn't on purpose. The GP is in the business of like raising money at the end of the day and buying properties and doing good by their LPs. But people are busy. Sometimes they're not so sensitive to certain things. And what ends up happening is both investment decks and capital calls are what I would call subpar. Like they're not so clear. Maybe they're missing. Maybe they're like too aggressive, right? Like maybe they're too salesy. Maybe they're missing some like extreme. I mean, I can't tell you how many decks I look at every week that don't have an address.
Huh.
You know what I'm saying?
Well,
Like,
that's what I'm talking about. That's exactly what the life of the GP behind the phone versus, maybe this is part of that due diligence is that, here at Smartland, look, if you go downstairs to the first floor, there's a whole office humming and buzzing, right? Between bookkeeping and marketing and leasing and this and that. And, I mean, maintenance directors and you got all the necessary and critical things that are required to operate a commercial real estate business. Okay. And so the question becomes is, maybe that's part of the main issue, right? That it cannot just be also where we began is that it's no longer just property managers are no longer just a commodity, right? Like it's not just going and buying whomever and whatever. Maybe it is just really doing that much heavier lift due diligence that's necessary and figuring out is there even a team behind these people? Like who are they?
yeah, I would say many times there is. Many times there is a real team. I'm just saying at the end of the day, it's actually pretty difficult to tell your story well. And you know, to your earlier question, that's what I help GPs with. Sometimes GPs reach out and they're like, "Hey, can you give me some independent feedback on my deck? Can you give me like I have to do a capital call. Here's why I believe in it and I think it's a good idea. Can you help me phrase it and like and model it how should I present this to the LP?" And by the way, I mean this might surprise some people, but in some cases, this is coming from GPs that have been around for like 20 plus years, right? They've never had to deal with a capital call, right?
Yeah, I mean,
But
even the
but
smartest guys got in a little bit of trouble this last round with where the market went.
yeah, and I just think I also think there's sort of while we're on this topic, there's sort of an unhealthy response from LPs to capital calls. Part of it is warranted, meaning if you get a capital call, you should definitely like look into your position, right? That's warranted. However, I just always remind LPs like not all capital calls are created equal. Some of them actually make sense, right?
Of course,
And
of
and
course.
and I actually just wrote about this 2 days ago on social. Like I'm sort of seeing GPs out there publicly saying I'm not going to ever make capital calls, and I think that's a disaster. Like how can you even say that? I just don't understand it, right?
Well,
Like you
I don't think I don't think there's a regulatory body that allows you to say that.
That's a whole other topic. I'm not even talking about legal, right? I'm not even talking about legal. Legally, it might be fine. I have no
I don't
idea.
know.
Probably not. But whatever. I mean, putting the legal legalities aside is just like, so what are you saying? Like, you will never have a property that will have challenges? Is that what you're saying? Because like, at some point you will, right? Everyone does at some point. It's just a matter
There's
of
no
time.
such thing as a no challenge property, period.
Exactly. And perhaps that challenge will be you need more capital. So then you sit there and you're like, oh, oops, I just told everyone that I'm not going to do a capital call. And so, okay, so let me raise 15% pref and stick it in front of the LP and not tell anyone. Did that help anyone? Like, I just don't understand it. I don't know.
Ooh, you just opened up a real can of worms there. I think this is the scary looming issue that people are underestimating, actually, is the pref equity that's come into the arena, and that they are the primary layer advance of LPs without a lot of LPs knowing. I think that there's a lot of limited partners that don't even know that one, that their deals would allow pref equity. Two, that they don't even know that pref equity has entered their deal that they're in, and what
Yeah,
that can mean for them.
true statement. I'm not sure that I have a lot to add. Yeah, it's a problem.
I
No, I'm saying
think it's a
it's a
pretty
big
scary. I think
problem,
it's a pretty scary.
and I think maybe to add like a further iteration of it, which is a whole other hour of conversations, is like um more advanced shenanigans, which is sort of like recapitalizations, converting to REITs, collateralizing your a bunch of assets together in order to get pref equity. All of these things sort of have implied values as part of them to make them work. And generally speaking, good properties are helping out the bad, even though each property typically will have different set of LPs, massive conflicts of interest. I mean, like, um, I guess I'll stop it there, but like, but yeah, I mean, it's a big problem.
Yeah, I think that's something brewing that we haven't. You're right that that is a whole separate hour for sure. But it's important to note that this is a ticking time bomb, a legitimate ticking time bomb that does exist within the same layer and sphere of um, capital calls, um, uh, value reduction, cap rate expansion, interest rates maintaining this pressure, notes coming due, and it's across the
Yep.
board. Yeah, listen, the sky is not falling, right? Like nobody's proclaiming the sky is falling, but everybody clearly knows that there's some sort of big hole developing in the sky.
Yep.
And so we all know that with it will come balance. And as I mentioned earlier, it's just Darwinism theory. It's a it's gonna the tough and uh, tough operators that can be not necessarily competitive, but I think that can be also creative in certain marketplaces where they've seen kind of this digression in value, and um, they're up against a note coming due. I think that it's important to implement creativity early on because it's hard to implement creativity later on in the game. And so if you know that, if you're a general partner and you're
Yep.
facing this issue, it's really important, correct, to get ahead of it as fast as possible because once, we're seeing it here, the challenge is that rationale begins to leave the space once the clock gets closer and closer to the due date. When we're looking and evaluating deals, sometimes, if we've been recently looking at more and more deal flow, and sometimes you're seeing that the creative thoughts are losing steam for some folks, and that's what we're going to be there, right? So that's the marketplace, and you pick them up on the backside. All right, so
Yep.
a little bit about just to finish this off, maybe some personal insights, and we'll kind of wrap it up today. What advice would you give, like an aspiring professional, to enter the field of real estate investing or investing advisory? Right. So you balance, your role as an advisor and also writing. And what kind of advice would you give to folks that are aspiring into the field?
I think the biggest thing that helped me is curiosity. Um, you should join. Well, I'll tell you something bigger actually, and I learned this very late in life. I think the closer you are to revenue generation within a business, the more money you can potentially make. There are very few exceptions to that. And if you're like sitting at a company and you're convincing yourself that you're still important, even though you're not close to revenue generation, in the vast majority of cases, you'll eventually realize that you're wrong. And this is not meant to be like a political statement or like hurt people's feelings. Obviously, some people are not so motivated by money, which is great, right? Like, I mean, everyone is different, right? But that's just the reality. It's definitely true in real estate, right? Um, and so the closer you can sort of join to revenue generation within a company, the more upside you'll likely have, all else equal. And from there, it's, like all the same stuff. Curiosity, you gotta like work hard, you have to learn, try to understand what your boss needs before they tell you what they need, right? Like things like that.
I think the underlying commitment is working hard.
Yeah,
Working hard, I think, always tends to lead the pack. So, listen, I want to thank you so much for your time and insights. It's really, really helpful. And I think that a lot of LPs and equally GPs can take something away from this, more so limited partners thinking about just evaluating potential investments, understanding that there's a lot of them that can be out there, building up trust. I think that was a major element that we covered. And just transparency, right? Like trust through
yep,
transparency, and yeah, and leading the way, right? So if you're going to make this investment or take this risk, make it worthwhile, because it does take a lot of due diligence effort, which is costly and timely, and those are
yep,
always interrelated, right? So, Aleksey, thank you so much for joining us on Smartland's Get to Know.
for
And
sure.
I am sure that we're going to be staying in touch for sure.
I'm looking forward to it. Thank you so much for your time.
Thank you. Thank you very much.